Ladies and gentlemen, welcome back to the channel. We have a problem. A new trade war looks to be starting as today we are getting tariffs 25% on Mexico, 25% on Canada, and 10% on China. I will give you the latest details here and what to expect for markets. Now, it was actually really weird what happened yesterday because markets were doing well. It was rumored that we were not actually going to get tariffs enacted until March 1st, that we would only hear about them tomorrow and get more clarity and details on them tomorrow, and then it would be a month until they're enacted. No, that apparently was false. That was a rumor that someone inside the White House said, and it's not true apparently. We're getting tariffs put on these countries today. And that caused markets to sell off, especially considering Canada has already come out and made some statements that they're going to tariff us back. And we already have a playbook for this. I think what makes Wall Street most nervous is this happened in 2018. If you recall, if you were investing during that time, this was the first trade war, and based on, where markets are today, it looks like nothing, but this was actually a 20% crash, okay, from October-ish, October 2nd or so, October 3rd, through Christmas Eve, markets fell 20%. This was a trade war, mainly with China at the time, and I think China's economy was in a place where they could actually afford to go through a trade war. Today, that's likely not the case. China's not in an economic position to try to go through a trade war with us. Neither is Canada or Mexico. But Canada, especially Canada, wants to try this trade war. So it looks like as we go forward, we're going to get some tariffs from Canada. And that's the fear that Wall Street has, is what is this going to do for inflation, for economic activity, if we get a trade war? Now, if this is just all we get from tariffs, 10% on China, that's bullish. 25% Canada and Mexico, we can live with that. So overall, I wouldn't say this is a huge negative for markets. Some would actually say this is a net positive, just to make trade a little bit more fair. After all, Canada has crazy tariffs already on the US, like 300% on butter, on milk, on dairy products, cheese, chicken, okay, let alone cars, 25%, and many other things that are highly tariffed from Canada. Could be a positive. But I think Wall Street doesn't understand tariffs are not inflationary in and of themselves. Now, if you start getting into a trade war back and forth, and that can be somewhat inflationary, in theory, you would say, if you keep raising the price level over a medium term time frame, I mean, you're gonna could potentially continue to raise prices. I mean, that would inherently be inflationary. But inflation is simply money printing. When you want to boil inflation down, it is always monetary creation and nothing else. At least that's what Milton Friedman said. And I think where a lot of Wall Street could be getting this whole trade war thing wrong is I don't think it's going to be inflationary as much as it is negatively impactful to the economy. So it could be an issue for corporate earnings. It could be an issue for economic activity like GDP growth. When GDP is starting to slow down, the last 2 quarters, we printed 3% GDP. Last quarter, it's down to 2.3%, which is still good, but you add a trade war to this, and you could see the economy slow down further from here, which, yes, would bring down inflation. It would allow the Fed to cut rates, but it's a slippery slope when the economy starts to weaken. And some people actually argue via the trade war back in 2018 is a big reason why the economy started to really weaken in 2019. A lot of people thought we were heading into a recession in 2019. That's why you got, a handful or so of corrections. And obviously that didn't happen. Things look to be getting better into 2020, and then you had the Rona, and the rest is history. But tariffs, from my perspective, are a bigger issue for economic activity, not for inflation. Now, Trump also said yesterday that we will be doing a very substantial tariff on the European Union as well. So everyone's getting a tariff. And to make matters worse, Trump said, quote, tariffs may cause short-term disruptions, not concerned about markets' reaction. So he's basically saying, F your stocks. If they fall in the short term because of tariffs, well, so be it. Now, Canada said, quote, if Donald Trump slaps 25% tariffs on Canadian goods, we must hit back dollar for dollar, starting with 100% tariffs on all Tesla vehicles and U.S. wine, beer, and spirits. Now, I mean, you gotta give it to Trump. He's trying to right-size things at least a little bit with Canada. Okay, look at these tariffs that Canada has on the U.S. Milk, 270% tariff. Cheese, 245%. Butter, 298%. And chicken at 238%. Agricultural products, 69.9% on sausage, 57.8% on barley seed, and 26.5% on bovine meat. Industrial goods. Tariffs on manufactured goods from the United States include 25% on cars, 25% on steel, 45% on aluminum, 48% on copper, 45% on HVAC units, 35% on vacuums, like come on, 35% on cable boxes, and 45% on TVs. Canada also applies tariffs on other U.S. products like baby clothing, athletic equipment, lumber, coffee, and some household appliances. I mean, that doesn't sound fair to me. I think the big story for equities heading into next week is going to be this trade war situation. If things get worse, that's number one. But how Wall Street starts to think about this. China is the most important trade partner that we have. If China's only getting a 10% tariff, that could be seen as bullish. That could be seen as good. Now, Canada and Mexico, they could obviously take things a step further. We haven't got much word from Mexico yet, but Canada does seem to be wanting to put up a fight. And this could be one of the bigger drivers of markets in this next upcoming week. Now, also next week, we have a ton of earnings. Like, next week is the big week for earnings season. Last week was huge as well, with just some of your big tech names. But the sheer quantity of stocks we are going to be getting this week and the following week is massive. On Monday, you have Tyson, some other names pre-market. In after hours, you have Palantir, NXP, Fabrient, and Rambus. Tuesday pre-market, you have PayPal, Spotify, Pfizer, Regeneron, PepsiCo, Ferrari, Merck, Estee Lauder, Apollo, and Enterprise Products. Tuesday and after hours, you have AMD, Alphabet, Snapchat, Chipotle, Enphase, Amgen, Electric Arts, Lumen, and Juniper. Wednesday pre-market, you have Uber, Disney, Novo Nordisk, Toyota, Boston Scientific, and Aora. Wednesday and after hours, Ford, Qualcomm, ARM, Symbotic, Viking, O'Reilly Auto Parts, and Aflac. Thursday, you have Eli Lilly, Roblox, ConocoPhillips, Peloton, Hershey's, Bristol Myers, Tapestry, Yum, and Philip Morris in the morning. In after hours, you have Amazon, Elf, Cloudflare, Affirm, Fortinet, Microchip, Pinterest, MPS, Victory Capital, and Powell. And then Friday, you have Canopy Growth, Flowers Foods, Fortive, CBOE, and a couple of other names in pre-market. So this is a massive week, again, for big tech. For a lot of your more AI names as well, Cloudflare, Palantir, AMD, right? Some importance there, as well as really the sectors are really broadening out this week. You're getting anything from food to energy to fintech to AI to big tech and commerce this week, we're going to have a great understanding of where the economy is, where earnings are, projections for this year, and really Q1 of any year is important because you get guidance, right? Technically, it's Q4 earnings that we're getting right now, but we're in Q1, and the guidance that we get from these companies for this year is going to be what drives these stocks higher or lower, and really what drives markets higher or lower, as long as nothing gets worse with the trade war situation. Now, we also have a lot of economic data as well coming next week. Starting off on Monday, you have ISM manufacturing PMIs. Manufacturing's been in a recession for a long time, so I don't know how much this is going to move markets. We will see. You also get construction spending, ISM manufacturing new orders, prices paid, employment, and other smaller data sets there. You have a speech from Fed Bowman, or Fed Bostic. We really want to see if the Fed is aligning with Powell, if the Fed is, dovish, or if they're more on the hawkish side. We heard from Austin Goolsbee on Friday, and he sounded very optimistic, especially on inflation, that inflation is making progress, while tariffs, if it's a one-time thing, would not need to be reacted to by the Fed. But essentially, if there is a trade war, then the Fed may have to respond to that. Okay. We want to see what other Fed officials have to say as well. On Tuesday, we're going to have JOLTS job openings. Think about it like this. The more job openings we have, the stronger the labor market. Okay. The lower the job openings, the weaker. If you are a business and you're looking to hire 5 employees, you're probably doing pretty good, right? If you're only looking to now hire 2 employees, you're probably not doing as good. And if you're not looking to hire any employees, well, you may still be doing okay, but you're not busy enough to need to hire more people. Okay, that's the best way to think about it. You have factory orders month over month, expecting a negative 1% number there. Not a great number expected. The TIPP Economic Optimism Index will also be coming out, expecting things to get a little bit better than last month. Last month at 51.9, we're expecting 52.3. So that could also be important. And then Fed Bostic speaks again, as well as Fed Daily at about 2 p.m. for Daily, and Fed Bostic at about 11 a.m. On Tuesday. At 7:30 p.m. as well, a late night speech we will get from Fed Jefferson. So a couple Fed speakers on Tuesday. On Wednesday, we will get the ADP employment change, actually expecting a number of about 120,000, which is roughly in line with last month's number of 122,000. We will get exports and imports and the balance of trade, expecting the deficit to actually narrow a little bit to 87 billion. Well, I guess that would actually be growing from last month's number of negative 78.2 billion. Expecting that to go up a little bit. For a second there, it looked like it was actually going to be falling. And that'll be important for GDP. Exports, imports, and balance of trade will give you a new GDP Now update from the Atlanta Fed, which is currently sitting at a forecasted GDP of, about 2.9%. As of January 31st, that was the last update that we got. But the average blue chip consensus from forecasters is about 2.1% GDP. So I think that could actually move quite a bit this week. Beyond that, on Wednesday, we get ISM services PMIs. This is most important because 70-80% of our economy is services, 20-ish% is manufacturing. So if services come in weak, then that's more impactful than if manufacturing comes in weak. And you're actually expecting the headline number will go up from 54.1 to 54.3. Anything below 50 is contraction, above 50 is positive. And the higher above 50, the more positive, vice versa. The more you are below 50, the more negative or contractionary it is. ISM services business activity expected to come in roughly in line with last month's number of 58.1. Employment expected to actually fall from 41 or 51.4 to 51.3. New orders expected to fall as well from 54.2 to 54.1. And services prices expected to actually rise from 64.4 to 64.8. You want to see that prices component really come down. That's going to be where the positive or negative move comes from on Wednesday. Is if prices come down, then Wall Street's going to say, well, that's really good. If 80% of our economy is services and prices appear to be coming down, that's great news for inflation. So that's a big catalyst to watch for on Wednesday. As well as that, at 1 p.m., you will get a speech from Fed Austin Goolsbee. At 3 p.m., Fed Bowman will be speaking. And then 7:30 p.m. on Wednesday, Fed Jefferson will speak. On Thursday, you will get the Bank of England interest rate decision. They're expected to actually cut rates, with some people thinking they could cut rates a little bit more than a quarter percent. Challenger job cuts are expected at 45,000. That will be coming out at 7:30 in the morning. Initial jobless claims are expected at 214,000 from last week's 207,000 number. So really good initial jobless claims we're expecting. Continuing jobless claims expected to pretty much come in line with the previous number that we got from last week. You will get Fed Waller that speaks at 12:30 and Fed Daily that speaks at 3:30 on Thursday. Friday is going to be your big data. You do get non-farm payrolls expecting 170,000 from last month's number of 256,000. So, we're back in that market where, at least with the labor market, good news is bad news is good news for now. Okay, so if we get a weak non-farm payrolls number, that could be a positive for markets. A high number could be negative for markets. So keep that in mind. The unemployment rate is also going to be coming out, expecting that to remain steady at about 4.1%. Average hourly earnings expected at 0.3%, the same as last month. And year-over-year average hourly earnings expected at 3.8%, which would actually be down from 3.9% last month. Participation rate, private payrolls, manufacturing payrolls, government payrolls. A lot of secondary data will be coming out there. As well as that, we get the Michigan Consumer Sentiment Survey, expecting sentiment to improve a little bit from 71.1 to 71.8. But the more important aspect of this is inflation expectations. 5-year inflation expectations last month were at 3.2%. We're expecting that's going to go up to 3.3%. That's not terrible, but it's not good. You want to see that number come down. And 1-year inflation expectations are expected to rise as well from 3.3% to 3.4%. So, a big week this week as far as economic data. And again, as far as earnings. I mean, there's going to be a lot to digest this week. And again, considering we had such a rough day on Friday, we were green. We were up almost 1% on the S&P, closing down 0.5% in regular trading, down another 0.5% in after hours. We're expecting to get more information on these tariffs today and the implementation of these tariffs today, and then probably tariffs from Canada being implemented tomorrow on Sunday, I would imagine. And we're going to be reacting to that coming on Monday. It's hard to make a case for a positive reaction there. But, it's possible. When the markets get fearful, you have to see things continue to get worse for markets to continue to get worse. We've seen from this earnings season so far, it's really validated a lot of the bulls, right? AI is here. CapEx is continuing to be spent. Earnings, generally speaking, are coming in better than expected. That's positive for markets. The economic data this week is going to be a real wild card. Is the economy strong? Is it weakening? Should the Fed be cutting? I think a lot of the consensus is going to be challenged this week, for better or for worse, right? Things could look a lot better by this upcoming Friday, or things could look worse, right? And I think whenever you have weeks like that, where the consensus could really change, it could set you up for a lot of volatility with non-farm payrolls, ISM services, challenger job cuts, big earnings. Now throw in the mix, you have tariffs, right? Potential trade war. These are things that could make for a more volatile market. Again, doesn't mean we have to fall, but it could just be volatile. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.